We've got a full agenda. Thanks so much for coming. I know there's a lot of competition during Climate Week, but given that we've got some pretty gloomy news, people will focus on the oxygen. But there's a purpose behind this gloom, and that's to take us back to some kind of reality. We've got extreme heat in Japan, which we're reading about, creating a crisis in their energy system. There's a heat dome over North America with extreme heats in North America. Southern Europe, Spain wasn't looking too great the other week. And we forget the urgency of dealing with climate change, which is what Carbon Tracker was set up to address. And the report, well, let's get down to the nuts and bolts of what this report actually says. The report says there's 40% more fossil fuels listed on the world's stock markets today than there were 10 years ago when we did the first carbon bubble report. Now, I'd hate to think that our funders are looking at metrics of success. But if you're looking at metrics of success, which was to keep the fossil fuels in the ground and to get financial regulators acting rationally, investors acting rationally, having 40% more looks like a failure metric, not a success metric. But that underpins that for all the work of the TCFD, love it, all the work of the GFANs, which I'm on the advisory board for, and all the writings that we see every day in whether it's the Financial Times or any other fabulous newspaper, we still haven't got it right. It's been Carbon Tracker's analyzes 2,500 coal, oil and gas IPOs in the last 10 years. And if we think about what's been happening on the world's stock markets, it's a bit like trying to run up a down escalator. You're told as a fund manager to decarbonize and to get to net zero and to align your portfolio with the Paris Agreement and to cut emissions from your portfolio. You're told to do all that. But every time there's another oil IPO, and am I right? Isn't Woodside coming? Is it already in London?
Yeah.
Is it already in London? Yeah. So we're told to decarbonize, but every time there's a huge listing of an oil company or a coal company, all the universal owners, all the passive investors have to buy it. So whilst on one side they're told to decarbonize, on the other side they inevitably have to buy more because the exchanges are getting more carbon intense. So that's kind of a gloomy picture. But when we set up Carbon Tracker, it was with the universal focus of getting financial regulators thinking about these topics, and also to get fund managers looking at the funding of the fossil fuel industry. And I still strongly believe in supply side measures. So do I have a little bit of good news? I was having to dig around. I don't dig around too much for the good news, but here's some of it. We've got two terawatt hours of installed capacity of wind and solar, which is growing at 20% per annum, and that's set to reach 40% of global generation in less than 10 years. Now, if we grow like that over the next 6 years, wind and solar capacity is going to reach 8 terawatt hours, 8,000 gigawatts, which is in 20 years more than all the global fossil fuel capacity amassed over the last century. How's that for an interesting fact? Because renewables are growing at such a pace, and so is the sales of electric vehicles growing at such a pace, we're actually seeing the peak in demand for fossil fuels. And this is the mystery that investors have to worry about, that we're building out more fossil fuels, we're building out more expansion, we're investing more in these IPOs that are happening at a time when demand for fossil fuels is reaching a peak, and we're in the middle of an extraordinary clean energy transition. So to close off my remarks, is just to remind ourselves that we've got two sides to the energy system. On one side, we've got the fixed assets of the energy system, the coal-fired power, the gas-fired power, the internal combustion engine cars. This is somebody telling me to stop talking, isn't it? We've got that on one side. On the other side of the fixed assets, we've got the flows, the oil and the gas and the coal coming into that fixed assets of system, the stock and flow. Now, in the new energy system, we're getting rid of half of that. There's going to be no need for any flows. The energy system is going to get smaller. And each year, the fossil fuel system spends $1 trillion keeping itself going, of $32 trillion of fixed assets. And as the energy system gets rid of the need for flows, the energy system will get smaller. and it will get cheaper for consumers. This is the fantastic positive message that groups like Carbon Tracker has got to get over to policymakers. My last remark is, let's do some fun maths. So there's 1,000 gigatons of CO2 owned by publicly traded companies out of 3,600 gigatons of total known fossil fuel reserves. The carbon budget's 360 gigatons. That's the figure of 90% has to stay in the ground. Now, if you calculated and multiplied today's price of gas and coal and oil by the reserves owned by publicly listed companies, and looked at that as a revenue figure, that's $113 trillion of revenue from those reserves that policymakers, shareholders think they have the right to see. And that's a net present value of $45 trillion. So that's the carbon bubble, guys, that we talked about 10 years ago. That's the unknown risk. And a lot of that expected revenue, let's suppose 90% of this has to stay in the ground. That's $100 trillion thereabouts of revenues forgone by governments. And that's the next battleground of rent seekers and oligarchs and governments and people who control the system. That's what they want to protect. And that's what we have to stop happening. Thank you very much.
So I'm Tom Allen. I'm the lead author of the report. And it's my pleasure today. I get to outline in 10-15 minutes the key findings from the report. And then I'm going to hand over to Mike Coffin, the co-author, who's going to talk about the implications for Paris alignment and the recommendations of the report. Okay. So what are the key points I'd like you to take away today? Firstly, to limit warming to 1.5 degrees, 90% of fossil fuel reserves need to stay in the ground as unburnable carbon. This obviously has huge implications for the companies that hold those reserves. Secondly, we find that these companies, and by extension their reserves, are concentrated in financial centres, just a handful of financial centres. And in particular, we highlight New York, Moscow, London, and Toronto as significant centres for oil and gas companies. By continuing to facilitate and profit from the ongoing development and production of these fossil fuels, these companies, these financial centres are at odds with national climate strategies and claims of climate leadership or net zero alignment. And finally, for the stakeholders and investors in these financial centres, they're exposed to the financial risks from the energy transition, and in particular stranded assets as the world moves towards a carbon neutral energy system. So starting with that first point, that 90% of fossil fuel reserves need to stay in the ground. To illustrate this, I'm plotting on the left the carbon dioxide potential of all discovered fossil fuels globally, and contrasting that on the right with the remaining carbon budgets for different temperature scenarios. Okay, so I mean, I was quite sort of startled when I first plotted this up, even though I kind of knew the answer. But if we look at just 1.5 degrees, we calculate the remaining budget at 320 gigatons CO2, whereas the total for all proved reserves is 10 times that value. Now, in this report, we are looking at the role of financial centres. So on the next slide, we'll show just a proportion of the bar on the left that is owned by companies with public listing. And we find that it's over 1,000 gigatons of CO2, which is alone, just listed companies alone, 3 times the carbon budget to 1.5 and about equal with that to 2 degrees. So this next slide is just to sort of maybe counter narrative that this is perhaps an NOC problem. So this is showing oil and gas production in 2019 in gigatons of CO2 terms. And what it's showing is that publicly owned companies accounted for the majority or the largest share of production than state-owned companies. So this is not an NOC problem. It's not a privately held problem. Listed companies are a big part of current emissions from oil and gas. So let's turn now to that concentration of embedded emissions by financial centres. So this chart is showing the same embedded emission data that I showed on the previous slide, but now amalgamated by the financial or the location of the primary listing for the companies that hold those reserves. And what we can see is that the significant share of about 70% of these embedded emissions are held in just 5 financial centres. So obviously we've got Shanghai, Mumbai, which is dominated by partial listings of domestic coal companies, but then New York, Moscow, Riyadh that have listed oil and gas companies dominated those emissions. And given our audience today, I'll point out London then 6th place, which is quite astounding given that compared to the others, it has a relatively modest domestic oil and gas industry. So a lot of these financial centres, as mentioned, include partial listing of state companies. So in this next slide, we correct for that state ownership. And what it does is it reveals, in particular, New York as a very important centre. I mean, so New York is, on this chart, is included the combined listings of the NASDAQ and the New York Stock Exchange. So it's quite unique in having 2 large primary exchanges in the city. You can see that Riyadh drops down. So this is basically the partial listing of Saudi Aramco. And you can see London and Toronto become sort of more significant. Just before I move on, just to sort of highlight a point that we make in the report, which is that although this is good to show where the accumulation of emissions where investors have perhaps the most influence, even for partial listed companies, they identify where investors have a relatively small amount of influence, doesn't absolve them from a responsibility for those emissions. And even a partial listing of a company provides an important source of capital and a veneer of credibility that provides access to lower borrowing costs and helps facilitate production of their portfolios. So it's not just about maybe a responsibility for bringing these reserves to market, but there's also, as discussed, financial risks. So if we are to meet the goals of the Paris Agreement, then a significant proportion of these reserves and emissions will not be produced. And so the next slide is going to look at the companies and financial centres that might be exposed to that. So this is showing the market capitalization early part of this year of companies that hold or have fossil fuel reserves. And you can see here, accounting for a free float weighting, in particular New York and London become sort of 2nd and 3rd most significant centres that have a large valuation connected with fossil fuel reserves. Now, in the report, we look at this a bit further and we look at the relative exposure of different financial centres. And so you can contrast New York and London. So New York has obviously a large amount of market capitalisation associated with fossil fuels, but also has a very large, for example, tech sector. And if you look at the share of the total market capitalisation, it was around 3%. Whereas in contrast with London, which still has a large market capitalisation, it accounted for 15% of the total market cap of for the London Stock Exchange. And so it's relatively a lot more exposed. Now, in the report, we also look at this a step further where we start to quantify the stranded asset risk for these exchanges. So this is another production chart, but it's showing the average production over the next 2 decades under a well below 2 degree scenario. It's plotted on the same scale as the 2019 chart. And so 2 things: one, you can see the production falls across the board quite significantly. And secondly, that there's a shift from state-owned companies to publicly owned companies. This is as a response of state-owned companies in the whole having access to lower cost projects. And so what we can take from this is that publicly listed companies have a greater share of exposure to, in particular, stranded assets under a low demand scenario. So this is my last chart. It's a bit complicated, so I'll sort of take some time to talk through it. But what we're showing here is the concentration of stranded asset risk by financial centres. So this is the result of our least cost modelling work that we do at Carbon Tracker, and it's looking at what oil and gas projects are needed to meet the demand under different temperature scenarios. So it's showing the potential future capital expenditure for just upstream oil and gas projects over the next 10 years. And these charts are then coloured by projects which that our modelling shows might be needed under those different scenarios. So we start on the right-hand side and the red bars. These show high-cost projects which our modelling work shows are not required even under a high-demand scenario. So for this, we use the IEA's stated policy scenario, which is a 2.7 degree scenario, and a good sort of proxy we use as a sort of business as usual investment decisions. So hopefully most of these projects will never see the light of day, but if they are sanctioned, they're at high risk of becoming stranded due to their high break-even costs. Next, we have the orange bars, and these are projects which potentially are required under the IEA's stated policy scenario, but that are not required under faster decarbonisation scenarios. So these would be shown in the yellow bars, which show those projects required under a 1.65 degree scenario, such as the production chart I just showed you. And taken together, the yellow and orange bars are the projects which are most at risk of becoming stranded under a low carbonisation scenario. And then finally, the blue bars are showing continued investment on already sanctioned projects. So the IEA stated last year that for no new investment on new oil and gas projects was required beyond 2021. So that's these bars in blue, which potentially fit into a 1.5 degree scenario. And what you can tell is overall, a large share of future potential CapEx is at risk under decarbonisation scenario. And obviously we hope that this happens, but it's this risk needs to be factored in and managed by those people invested in those companies. So I'm going to hand over to Mike now, who's going to sort of take this a bit further and talk about alignment.
So good afternoon, everybody. So Tom's just taken us through the embedded emissions in the reserves globally, and the fact that 90% of those cannot see the light of day if we're to reach 1.5 degrees. We've shown that listed companies are a huge part of that problem. So a significant portion of those reserves are held by listed companies. We've seen that those listed companies are concentrated in just a few financial centres globally, and that investors, and both directly in fossil fuel companies, but more broadly in a whole range of other financial services companies, but also in other parts of the fossil fuel value chain, are exposed to the transition risks that result from and the stranded asset risk that results from this. So having talked through that, what I'd now like to do is look a little bit around, use some of the same data and talk about alignment, both, say, for example, with Paris alignment, but also in terms of net zero and claims of net zero and the sort of somewhat nebulous concept that is in itself, particularly in terms of climate leadership, but also then think about some of the recommendations for stakeholders. Okay, so first, before we do that, I'd like to just give a little bit of a summary of what does a Paris-aligned company look like. So I think for us, it's important to look first at what a company looks like, and then we can start thinking about what does a Paris-aligned or net zero-aligned financial centre look like. And so I'll just give a recap of some of our existing work here. So first, the question, what does a Paris-aligned company look like? So first, we can look at the capital allocation decisions. Are new developments, are company plans compatible with Paris alignment? Have companies got a track record of sanctioning those high cost products that are just not needed in a low carbon and low demand world? And for that, we just look at CTI or Carbon Tracker we've done our least cost modelling. And I've just put some of the images of our most recent reports as a bit of a shameless plug on the right. So that's the first piece, and Tom just showed us some of that data from that least cost modelling on transition risk. And then so the second angle we can look at is we can look at emissions targets. So we can look at how emissions targets and companies, particularly for oil and gas producers, are emissions targets framed appropriately. And we've outlined our hallmarks of Paris compliance. So that's 3 fundamental prerequisites we think that company emissions targets must have for them to potentially be viewed as Paris aligned. And of course, they have to have appropriate sanctioning decisions too. And so the third aspect of this, we can look at a remuneration as well. So the company, personal incentives of these companies, do they support company strategy? So strategy aligned. And we've produced a series of reports on that. And then if we move through to the final point, we've also looked at climate risk disclosure. So is there adequate reporting? And my colleagues in the accounting, audit and regulatory team published a report last year called Flying Blind, and we've also produced company profiles. So across those 4 different lenses, you can assess, and you can assess companies across those 4 different lenses to see if they're Paris aligned or not. And I wanted to just start on this point because we can look at financial centres more broadly with those same 4 things in mind. So moving on to the next slide, we can look at that same data that Tom just showed us, but we can look at it in a relative sense. So the 100% bars on this chart is exactly the same data for those same financial centre. At 100% is our the projects that we see going ahead under the business as usual proxy, which is the IEA's, International Energy Agency's stated policy scenario. That's a 2.7 degree scenario. So you see all the orange bars line up at 100%. So what we can see for each country between 0 and 100% is their business as usual capital expenditure plans. So for all of the companies, so we've aggregated the company capex plans for upstream oil and gas by the financial centre of the primary listing of those companies. And so we can see that for New York here, reading off the chart there, only about 30% of those company capex plans are aligned with the 1.5 degree C scenario. Looking at a well below 2 degree scenario, so we use the IEA's sustainable development scenario, 1.65 degrees. So that's then the green plus the yellow bars. We see just 40% of New York companies' capex is aligned with that well below 2 degree scenario. So we can see these are ordered here by the degree to which company capex plans are not aligned with that 1.65 degree, a proxy for Paris, well below 2 degrees. We see additionally that Brazil, and then also actually Sydney as well is particularly exposed to under a 1.5 degree C. So of course, we looked at that from a transition risk perspective when Tom was describing that first, but here we can look at this same data from alignment perspective. Company capex plans, and of course, all the financial services that support those and the other parts of the oil and gas industry. This is upstream. Of course, there's the refiners, there are the midstream companies, there are transport companies as well. All could all be viewed as complicit and ultimately not aligned with climate goals. Of course, we could use those we could look at those other lenses I just showed, and we could look at companies and aggregate them again by stock exchanges and financial centres. We've chosen here just to focus on this capex data. I should also point out on the right, we see those red bars that Tom showed. Those are the particularly high cost projects that we see as potentially, if any of those were to go ahead, they're very much not aligned. And again, we can see that New York, Oslo actually there, and then Sydney are financial centres that were such projects to go ahead could be viewed as particularly unaligned with the goals of the Paris Agreement. So moving on to the next slide. Let's just come on to some recommendations and next again. So sort of 2 sets of recommendations. One, policymakers and regulators, and then we'll move on to some for investors next. And I should say, we don't claim to be policy specialists here at Carbon Tracker, and I hope the panel we have next will speak to some of the policy implications. But we're very much trying to raise awareness of the problem and just give some high-level recommendations at this point. So first, policymakers must ensure the activities of stock markets and the financial centres more broadly are aligned with any claims of climate leadership or net zero goals at a national level. Second, they must also recognise the financial risks to a whole range of stakeholders, primarily investors, but also more broadly, that continued investment into the fossil fuel system exposes those stakeholders to. And so moving next slide, regulators must also ensure that existing disclosure requirements are adequately enforced. And this is fundamental. There is a significant amount of existing regulation, but it must be appropriately enforced. And this includes, for example, auditors. Auditors actually putting in place existing regulation and then regulators holding them to account. They could consider increasing regulatory oversight, again, looking at some of those lenses of different lenses of Paris alignment, and introducing rules that go beyond TCFD, for example. Then finally, we can see on the final point there, potentially updating listing requirements. Do we need the listing of any new fossil fuel companies, given the degree of embedded emissions that we've already seen in listed, already discovered resources? And then so moving on to the recommendations for investors, we believe that we urge, in fact, all investors to become active owners. And I'm not going to read the whole slide, but it's really requiring companies to adopt strategies that are aligned with the goals of the Paris Agreement. And again, are not profiting, so that companies are not profiting from the release of emissions that take the world beyond climate limits and are reducing their exposure to transition risk in an orderly manner. And it's critical that investors scrutinize companies' plans and hold them to account in doing this to protect both the planet and also their own interests. So to sum up on the final slide, just to recap really what we talked through there and the summary of the report. So to limit 1.5 degrees, 90% of existing discovered fossil fuels must need to stay in the ground as unburnable carbon. And then we talked through that listed companies are a huge part of the problem, and it's a specific those companies are concentrated in a few financial centres, particularly New York and London for oil and gas companies. And those companies and the financial industry around them are effectively complicit in or potentially could be viewed as complicit in taking the world beyond climate limits, of course, from profiting. We talked about alignment and the potential credibility and claims of credibility of climate leadership. Financial centres are supporting oil and gas and the release of these emissions beyond climate limits. They're somewhat at odds with national claims of net zero alignment or claims by individual stock exchanges of net zero alignment. And again, we go into that in more detail in the report. And we also looked at transition risk for investors and stakeholders. And as I said, the slide Tom showed just looked at the quantification of stranded asset risk in absolute terms for upstream companies. A report that we did 2 years ago by one of our colleagues looked more broadly, and you can see a figure potentially of $19 trillion at risk from companies directly and indirectly exposed to the fossil fuel system as potentially being at risk. That is a big, clearly a sizable number. So those are the 4 points we wanted to leave you today. I hope you enjoy the reports and thank you. So I think we'll now move into the panel. James, if I can invite the panelists up and then James.
Welcome all. Excellent. I'm James Murray. I'm editor of Business Green. I'm delighted to have a fantastic panel to discuss this hugely important topic. Obviously, we've got Mike from Carbon Tracker, who has just been speaking. We're also joined by Oscar Warwick Thompson, Head of Policy and Communications at UKSIF or UKSIF. I'm going to say UKSIF. Excellent. And Tiffany Grabsky, the SSE Academy Head for the UN Sustainable Stock Exchange. So many questions we can start with. Mike, I'm going to start with, I was just sitting there listening, watching this, and we wrote the story about the new report on Business Green earlier this week also. Can you explain to us why we might not be completely screwed? Because it sounds terrible, doesn't it? I mean, it sounds like they're either going to burn it anyway, in which case any hope of keeping below 2 degrees is gone, just completely gone within a very short time frame, or the entire world financial system is loaded with unbelievable levels of stranded assets that are going to have to be written down, and we're going to have a very messy transition. Is there a third way here, or is that kind of what the world is looking at?
Yeah, good question. Another problem there. I mean, so I think I'd make a few points there. One would be that the potential and the power, I think many in the room are cautiously optimistic, and I say cautiously optimistic, that the role that renewable and other alternative energies can play in accelerating the energy transition. And that the costs of renewables are falling rapidly globally. and in many parts of the world are cost comparative with or cheaper than existing fossil fuel sources. So, and some of the work we've done at Carbon Tracker is looking at the rollout of those and how that rollout will accelerate could accelerate quite rapidly this decade. What that does, so that's cautiously optimistic on potentially limiting warming to less than 2 degrees, but that doesn't do anything for the stranded asset risk for those in the incumbent oil and gas sector that are continuing to invest heavily. And it's still exposing a whole range of stakeholders to those significant stranded asset risk. And that's why we're raising awareness of the problem through those different lenses. And I think the second point would be around optimism would be the growing awareness of the problem and the stranded asset risk, particularly among universal owners, and the fact that long-term investors, the costs of dealing with warming well in excess of 2 degrees are far in excess of the costs of changing the energy system, even though those costs are still massive in themselves. So I'd sort of talk to those 2 points about cautiously optimistic. But a lot of change needs to happen, and rapidly.
Cool. And just one other point on that, sort of trying to square the circle. Obviously, playing devil's advocate, if I was working for an oil and gas company here, I'd say carbon capture and storage, direct air capture. There are ways that could ensure that these assets don't have to be stranded. They could still have value in a way that doesn't result in emissions. Not to do their PR job for them, but that would be the argument. Is it presumably your report's position that is stretching credulity?
Yeah, so it wasn't so much in this report, but a report that we put out about a month ago called Absolute Impact 2022. As one of the focus of that was looking at climate targets that we've done for a number of years, but also very much focusing on the credibility of those climate targets and looking at how are companies planning to achieve those targets. So we talk there about the hallmarks of Paris compliance and setting targets in an appropriate way, but the way companies have strategies to achieve those targets must also be credible. So they can't just achieve that through asset divestments or through sanctioning projects such as carbon capture, utilization, and or storage. And I just think it's really important to note, and I may get the figures slightly wrong here, but I think it's about the world, we produce about 40 gigatons of CO2 annually at the moment, and annual capacity of CCS at the moment is about 40 megatons. So it's many orders of magnitude lower. I think also companies may claim to offset their operational emissions through CCUS. That's just 15% of the problem. It's dealing with the 85% of the consumption emissions. It may not be the responsibility of the producers, but producers' business models certainly profit from those end-use emissions being released to the atmosphere.
Absolutely. Tiffany, I'm going to come to you. One of the other sort of points that try not to despair too much is that the original report this is an update on is 10 years old. And the logic behind it has always struck me as pretty impeccable. And most people, when you explain it to them, nod along and agree. Why hasn't more changed? Why haven't we seen more progress of companies starting to wind down these stranded assets and transition away?
Well, that's a great question. If we could answer it, then I guess we'd probably not be here right now.
Could the people in this room just solve everything now? That would be perfect. But no,
I would challenge that nothing's changed.
Right.
Because I think a lot has changed. And if we're talking about financial centers in particular, let's unpack that a little bit. What is a financial center? We've said a lot, a stock exchange, what's listed on a stock exchange or multiple stock exchanges, but a financial center is much more than a stock exchange. A stock exchange is a service provider, a financial service provider that enables that transaction to happen. But we have people investing, and we also have all the other players involved in moving money around. So let's look at what's changed there. And I think a lot has changed. If we look at the growth of the members of the UNPRI, for example, we look at the TCFD, even just regulation related to TCFD and how quickly that's changing. I mean, we do training on TCFD, and every other week we're having to update our slides with the regulation changes. And we're faced with companies coming on these webinars for training in a panic because they have no idea what climate related risks and opportunities are. And I think we have to sometimes pull ourselves out of our bubble of what we work in all the time. And companies are now getting pulled into that bubble, and they haven't been in it for a very long time. And they're getting there now. So I think the system's changing. We're changing the products and services that are offered, and we're moving in the right direction. Clearly, that's not impacted directly into the reserves. However, also capital markets have grown significantly as well too. But one thing I wanted to highlight.
So just before we move on from that. So the point would be there again, caveats applied, but there would be an optimistic take that there's a lack here. That the kind of the recognition's come, and over the next 10 years, we'd start to see assets being
We hope
wound
so.
down and
I think there's
transitioned away.
two things that we need, and one Carbon Tracker does very well, and it's the urgency. We really need to hit home that urgency, and I think we're moving in that direction from regulation. Companies are taking note now because regulators are telling them to take note now, which is, you know, sending all our accountants in all directions, and they're not really sure how to handle this, but we're getting urgency and people are paying attention. But attention's not enough. We need education, we need training, and we need data. So that's the other side of the coin, which I think is improving. We're clearly not there yet, but we are moving in that direction. To give you an idea of what stock exchange is particularly doing, because that's the area that we work in. So we I think just last week launched a database looking at what stock exchanges are doing. And they're doing a lot, actually. And I know that the London Stock Exchange got highlighted a bit in this report for maybe a false net zero commitment. But I think we have to be a bit realistic about what stock exchanges can do and what's within their power to do. And the London Stock Exchange was the only stock exchange doing everything we recommended on climate. So they're actually really a leader in this area. So the things that they can do is they can provide guidance and in published guidance on how to disclose information. So we have 40 stock exchanges already including climate-related risks and opportunities in their ESG guidance documents. And then we have 4 stock exchanges that have particular guidance on climate. So they've pulled that out and said, this is totally different even from what we're talking about sustainability. This is something that companies need to address separately, and they're providing separate guidance on climate-related disclosure and risks and opportunities. And then that leads into a lot of the net zero stuff, which we're not including obviously in the TCFD area. But then they also do training, and a number of stock exchanges are now training markets on what does this mean and how do they do anything about that. And we're nearly at 40 markets as well that have done training on TCFD with their markets. And it's an opportunity for then companies to be in discussion with the stock exchange. And where we like to leverage stock exchanges, that communication point, we need to understand why companies aren't moving forward on this. What resources or knowledge are they lacking that we need to provide more of? And same with the investors. What resources and knowledge are they lacking that we need to provide more of to move this forward?
And what's the reaction to that from companies? I mean, obviously it'll be a spectrum. You'll get some that are warm to it. I mean, but you'll get others like the recent story at HSBC that one of my colleagues reported on that went a bit global. You know, the guy was saying what many of his peers think. They do this trading and they go through the motions and then they go back to trading as many fossil fuels as possible because they think the whole thing's bullshit. I mean, what's your take on the extent to which those arguments are cutting through with the decision makers that matter and the people who are allocating capital?
I think we're not going to get everyone in one swoop, right? We have to all work together and all push towards this end target. But if we come from all the angles, and the reason at the UN SSE, we don't just work with stock exchanges. We work always with stock exchanges, with regulators, with policymakers, with investors, and with listed companies. And all of them always should be in all the work we're doing because it's easy to point the finger at somebody else in that system.
Yeah.
But when we're all working about it together, we can make that happen. When there's regulations, they're going to be pushed to move it a bit more. And in that moment, they need the knowledge and education and training to be able to do that.
Oscar, I'm going to come to you with a couple more big picture questions, and then we're going to get into a little bit more of the detail of the report and actions. We've got a good half hour or so and take questions from the floor also. This argument of that there has been progress, and there absolutely has. We've made, the significant momentum. We're, moving forward in lots and lots of ways. It would have cut through even more so 6 months ago. And yet the circumstances have changed. But literally just today, G7 have signed off on a communique that there's, they say there's going to be climate tests and so on, but it's essentially we're happy to invest more in gas. Boris Johnson at the weekend saying we need to get past our phobia of hydrocarbons, which is an interesting way of putting it. But, is there a real risk that just as this argument was starting to cut through, we are now going to see a backlash in the name of energy security and people rationalising these investments, even as Mike has impeccably explained, they're high risk investments, potential stranded asset risk. But you're going to see governments and businesses just go, no, we still need to do this quick.
Yeah, I definitely agree with that, and it's certainly a worry for us at UKSIF and many of our members. As you say, 6 months ago we hosted COP26. The eyes of the world were on us. We had a fantastic series of commitments, albeit only just keeping a 1.5 degrees Celsius threshold within reach. And it seems since then, we have lost a lot of that hard-won progress, and it's extremely concerning to see. And it's something that, our members, who are mainly kind of sustainable investors, looking to put clients and savers' money to work towards the transition, to funding transition, are extremely concerned about. All the examples James just cited, completely agree with. We saw in the UK's energy security strategy, commitment to explore domestic oil and gas production in the North Sea. Since then we've had confirmation of a project going ahead in Jackdaw in Aberdeen. Also, the list goes on. Regulatory approval to drill gas on the outskirts of the iconic Surrey Hills in southwest Surrey. Policies around the windfall tax that we've seen, or energy profits levy, as I think the government's calling it. So that is effectively incentivizing oil and gas producers to make new investments in new domestic projects, which is absolutely, not the way we need to be going. I've got countless examples that I can point to in terms of, how we are reneging on the commitments that we made at net zero at COP, which, as I said before, all the commitments made, would only still barely keep 1.5 degrees Celsius alive. So the fact that we're backtracking what we already committed is extremely worrying for us and our members. So I think addressing that needs to be an absolutely key priority. And I think for us, we want to bring the voice of investors, saying that actually, we can't backtrack on what you agreed at COP. We need kind of more regulation to provide that kind of policy clarity and that policy landscape that's kind of clear, that can point investments in the right direction to funding the transition. And it's the signals and the clear policy landscape that our members, really, really need. These signals need to be the right ones to get capital to go to the right areas and away from the continued expansion of fossil fuel production, heightening the risks of a carbon bubble, as the report eloquently points out today.
And how do you land that argument though? Because in Whitehall, in number 10, all around the world, they're looking at it now and going, energy bills are absolutely killing us. They're going to, possibly bring down governments. We're really worried about this stuff. And the simplest lever we can pull, the one we've always pulled traditionally, is just more fossil fuel production. We feel that's the one. That's how we defang Putin. That's what we need to do. How do you get them past that simplistic argument?
I think by demonstrating that there are policy incentives and policy levers that government can use, and the government shouldn't be afraid to kind of use these, that can address both the twin crises we face, as you say, James, when it comes to the UK's energy independence, but also the pressing crisis we faced in regards to climate as well. There are clever policy interventions that can be made to address both. On the energy demand side, that's something that comes up from our members that tell us to lobby government on every day. Energy efficiency measures for one, for sure. We published our own report on how we can deliver a net zero line financial service centre. And we talked a lot about the missed opportunities in the UK's net zero strategy in terms of doing much more in energy efficiency. And surely the government can be much more ambitious in that area, encourage investors to invest in this area by bringing forward the government's existing energy efficiency targets, which is to have, I think, an EPC rating of C plus by 2030, I think, for fuel pool homes, and 2035 for the rest of the country.
Yeah.
Rest of the properties. Let's bring that forward. For us, that's the exact type of policy intervention we want to see that can address the crisis that we're seeing, say, on climate and energy efficiency. And I think, in terms of your question, James, on how can we get government to listen, I think the investment community needs to ramp up its rhetoric. Given what the science is telling us in terms of kind of the crisis that we're facing, I think there's a role for investors and organizations like UKSIF to really kind of ramp up the rhetoric and try to get governments, government here in the UK and others to act the scale and pace that's required.
Yeah, absolutely. No, it's a fascinating question, isn't it? Because I think there's a sort of knee-jerk reaction within government of kind of like, do you really want that? Or do we listen to the arguments that Mr. HSBC put across, and we feel that's the default, and it's maybe it probably does need that even more vocal counterweight. Mike, let's dive into the specifics a little bit. On the report looks at coal, gas, oil. Where do the biggest risks lie? And asking you to do a little bit of crystal ball gazing here. How do you see this playing out? What are we? Again, I look at the transition plans. Within less than 10 years, fleets all over Europe are going to be predominantly electric, even if governments kind of do half of what they say they're going to do. I mean, how does that play out for the oil majors? Has that penny really dropped yet at the pace and scale of the change?
I think it's starting to, and it's potentially starting to be seen in the level of sanctions, particularly amongst the product sanctions and investment decisions. And we are starting to see, when sanctioning levels last year, this year, obviously somewhat hard to deconvolve the impacts of COVID versus the impacts of the Ukraine war. But yeah, sanction levels are still well down on 10 years or so ago, particularly from the listed companies. They're starting to get this message. Partly there's a challenge for particularly if listed companies divest assets and divest to private companies. So I think that's clearly another area of focus here. Obviously, we're looking at listed companies, but we need to look at the whole, in time at least, the whole financial system. But in terms of the implications there, obviously, it's one of timescales is one of the key problems. And I think that's to your previous question as well. If we're investing in fossil fuels now, then how long does it take for those fossil fuels actually to come on stream, be developed, come on stream, the production to happen? When are those cash flows coming? What are the commodity prices in a decade? So if you're investing capital now, particularly if you're incentivized by current high prices, risking overinvestment. And so listed companies potentially exposing their stranded asset risk. But I think there's a second aspect here, which is continuing investment, say, for example, in Africa. So you see a lot of European countries investing heavily in fossil fuels and supporting countries, petrostates or emerging petrostates to invest heavily into fossil fuel infrastructure that's not needed, potentially wasting and eroding a lot of capital and a lot of value, and helping or pushing countries to continue or even deepen a fossil fuel economy, where really we need to take for the whole world to move away from fossil fuels. And I think that sort of touches on the previous question slightly around, imagine a world where we hadn't had the renewable investment we've had, even just in the UK over the last decade, and a situation where our electricity mix had no renewables and was even more fossil dominated, and the impact that would have on pricing. So we've already seen, this is already a case study of why investment in alternative energy sources is really important. And we just, for security and the planet, we only need to strengthen that as well.
Absolutely. Tiffany, anything to add to that? I mean, how do you see it panning out? Because as I say, if I'm being a fossil fuel company representative again, the argument is we can elegantly step away from this. We can unwind our position as the demand changes. Look, we are diversifying. I mean, Shell does run Europe's largest electric vehicle charging network. BP are pretty close behind. I mean, do you see any chance that they can basically unwind these stranded asset risks as required?
Well, I'll respond to your question. Has the penny dropped yet? And I don't think it's quite dropped yet.
Yeah, no.
I think we would have seen much more of a reaction if the penny's dropped. But we were having a conversation earlier about the research that Carbon Tracker does, and how much of the investment are these companies now shifting towards renewables and energy, and it's not enough. It was, what were you saying, about 20% more or less? Like,
I wasn't, but I think it's even less than that.
In top companies though, like even the best ones are still, a fifth of their investment is going in that direction, which to me implies that no, the penny has not dropped. It's far from it still. But I think if anything, what we've noticed in this, even just in the last 10 years, how quickly things can get momentum, how quickly they can change. So when that penny does drop, I think it'll happen very quickly. It'll have to happen really quickly. So how are we preparing? How are we preparing for this? I mean, we can all just keep beating this drum. We still have the urgency that we have to work on, but we also still have that knowledge and training, I think, we have to work on, and we have to keep preparing and keep developing that knowledge so that when the penny does drop and companies realize their options are pretty limited, they have something they can do with it. They have a direction to go at least. And I don't think pushing divestment necessarily is our best direction. If we say, let's delist every fossil fuel company, okay, where are they getting their funding then from? Because the stock exchange is not the only source of funding.
Yeah, who's picking up the assets?
And the stock exchange has transparency that other financing mechanisms do not. So encouraging that transparency, pushing for the data, and keeping that drumming, I think is quite important.
We have a whole separate session on divestment versus engagement, but I mean, Oscar, I'll bring you here on this because you mentioned COP and that there was this sort of big wave of really, on the face of it, impressive commitments, and the argument from green NGOs ever since has just been, hang on, a lot of this is close to greenwash. Is the engagement really happening? Are we really seeing voting against management? Are we really seeing the pressure applied to say, hang on a second, this is my pension fund, this is my customers' money, and you are risking it on projects that are basically at high risk of being stranded. I mean, what's your take on the current temperature of that level of engagement? And is there evidence that it works? Because again, the NGOs would say, look, it just isn't working.
Yeah.
We need to just deny them the capital.
It's a really great question, James. I think from our perspective, yes, we are sort of among those, I'd say, green NGO, but we also kind of have a membership. So we now have about 300 members representing £10 trillion of assets under management now. So, investors and other financial institutions, asset owners and banks, and ESG data ratings providers, among others. So we're sort of quite close, we feel, to kind of what members are doing. And we do think, stewardship and engagement does work. And there are kind of examples of kind of, how good stewardship can actually, lead to results. So companies better reporting to clients and savers on the impact that climate change is having on their businesses and operations, and the steps that in response companies are taking in response to investor pressure. Obviously, there's a huge amount more that we need to do, what the companies need to do and investors need to do in their stewardship role. But I think from a starting point, our view is that, stewardship engagement, with companies across the whole economy, including those in the fossil fuel sectors, it does work, but obviously there's more that needs to be done. So, it needs to be enhanced a lot further to ensure that the economy is aligning to the goals of the Paris Agreement at a much faster pace that we're seeing. But also, I guess, we want our members to think about stewardship more holistically. So not just what you're doing with investee companies, but what you're doing in terms of your engagement with policymakers. What sorts of policies are you talking to governments and other policymakers about? So for us, that would be a price on carbon, something we really want to see happening, phase out plans for kind of domestic coal production, a whole suite of kind of other policies as well. But yeah, I think stewardship and encouraging investors to see stewardship much more holistically, not just in relation to domestic companies, something we want to see. And also there's a sort of lobbying aspect to it as well. So, encouraging companies which invest to sort of undertake their own advocacy and lobbying for net zero line policies in their own sectors. That's kind of another key thing to do. So I think, from our starting point, UK CIF, stewardship engagement, it's great, it works, but there's a lot more that kind of still needs to be done in that area.
Yeah, absolutely. And just finally, before I open up to the floor, one last question, actually for the whole panel, but Mike, I'll start with you. Obviously, we've seen this stranded asset risk grow in the last decade, remarkably, even as most people, well, even not most people, but even as a large section of the investment community have kind of agreed with your analysis, not put forward a particularly credible alternative analysis, and yet we've still seen this stranded asset risk grow. How big a systemic risk does this now pose? I mean, I've lived through 3 economic crises already, and not only just turned 40. I mean, is there another one in the pipeline because of this?
Oh, that's a very big question, and maybe one I'm not fully qualified to answer. But I think clearly it does raise, and I think the points we talked, particularly around the timescales, I think is the piece I'd come back to is that when this does happen, when the stranded asset risk really does materialize, it could all materialize really quite suddenly. And as Mark said in the introduction, it's that lost revenue that people are potentially expecting to come that could really hit home. And again, we put a report out last year talking about the petrostates and the loss of revenue for oil and gas exporting countries. So their economy is based on this revenue stream. But if it totally fails to materialize, and it could happen quite quickly from an energy transition driven both by rapid rollout of new technologies and through policy action, those 2 levers could cause that transition to happen really quite quickly. Will it cause?
How quickly do you think? How quickly is plausible? I mean, we're talking like net zero targets, like what? 28 years hence now, which is obviously a blink of an eye in infrastructure terms. But equally, everyone switches their car every 4 years. How sort of compressed a time period could?
Well, I think that's it, as you say, in Europe, and obviously mobility accounts for a significant. Over half of oil demand is for mobility. That's light and heavier mobility too, so cars and heavier. But it could happen really quite rapidly, and you've seen particularly in some countries, obviously led, for example, by Norway, but other parts of Europe, how quickly that can happen. And as you say, people can turn over cars quite quickly. How quickly? Hard to put a number on it, but we do see that whether oil demand or fossil demand has already peaked in 2019 or is going to peaks in the coming years, we could see, particularly towards the end of this decade, really quite rapid falls under some credible scenarios as a result of the rollout of those new technologies. And that really could have a quite dramatic impact on commodity prices, and thus that stranded asset risk really coming to bite to a whole range of different financial market participants.
And that's not because the demand disappears overnight. It's just because the valuations change drastically because it's not going to be there.
It's a bit of both. And I think if you look back to the coal industry 10 years ago and you look at valuations of coal companies versus when there was peak demand or peak consumption of coal versus the peak and the market capitalization of the coal companies, you can see that even around the peak, and this is one of our former colleagues' work looking at this, you can see quite clearly that that even around peak consumption, peak volume, that's already the valuations are already starting to. And at the same parallels, the similar work was looking at, say, Blockbuster versus Netflix. So we've done a lot of work in our energy transition team looking at how these transitions can unfold and how they can unfold quite rapidly. Yeah. And the implications, as you say, is people realize that the traditional way of valuing an oil and gas company, looking at reserves replacement ratio, doing DCF forecasting with some terminal value, are just inappropriate for an industry that's in decline and ultimately is, to shrink massively over the next 2 decades or so.
Absolutely. No, there's going to be a lot of blockbusters. Tiffany, you work with financial centres. How concerned are you about just the whole system stability when, as we saw, such sizable chunks of it are built on these high-risk assets?
Yeah, I think Mark Carney covered it well when he did his speech on the tragedy of the horizons. But the fact that the TCFD exists, which was central bankers coming together and saying there's systemic risk here we've not accounted for, signals that there's a real concern. How we're going to react to that concern now is where we're at now. But I think it's clear that it exists. That the central bankers might be talking a bit louder right now, but every participant understands that risk is there. They're just all deciding at different levels and at different stages how they react to that risk.
Yeah, no one can say they weren't warned. That's going to be a big part of it when we do start to assess it. Any questions from the floor? We've got about 15 minutes before we have our closing speech. Gentleman at the back has a question. Excellent. Thank you. For those watching digitally, of which there are over 50 still, I can see. So the question was about valuations, and valuations have soared for these companies, as you point out. So on the back of high oil and gas prices, are those valuations incorporating this stranded asset risk at all? Would they be higher still if they didn't understand this, or as the question implies, are these valuations just completely failing to get a grip on the medium to long term risk that these companies still face? Mike, so feels like a question for you first.
So thanks for the question. Yeah, absolutely. Look, so we're not here to comment on specific valuations of companies, but what I would say is, have they been priced in? Difficult to say. Clearly there is some recognition, particularly for those leading companies we've talked about. But obviously the high commodity prices has led to those valuations going up in the stock market. I think it's really important to recognise the difference between the financial instruments that people are invested in and the value of the underlying assets that the companies own. And clearly there's and the degree of leverage involved as well. But I think I'd also I'd throw a comment to the room here again about timescales and incentives that we just talked about. So what is the timescale of the equity analysts, particularly on the sell side? What are they looking at? What is the timescale that they're looking at? What are they personally incentivized about in terms of writing and evaluating companies? Is that 18 months? Is it 12 months? Is it 10 years? So I think that would be one comment. And I think,
Sorry, just to interrupt, that was the HSBC guy's point almost, wasn't it? Is that we're going to hold this for less than 6 years at most. And I don't care what happens beyond that, which I think was his precise, slightly loaded phrase. But that's the argument they can present, that the valuation's high now, I'll take advantage now. I don't really care what happens down the line.
but I mean, somebody's going to be holding those financial instruments when the party stops, and whoever's holding those is going to be the one that suffers the loss in the value of those shares. So predicting that, and I think there again has got to be, we need to draw the separation between the transition risk and then also the alignment perspective. And I think obviously growing assets under management with some form of net zero or Paris alignment mandate, those assets are growing, and the more that grows, that clearly plays in as well. But I would just come back to that incentives, and I think the models maybe are changing, but I think for all of us in this room, it's a call to help inform how we value these companies. And are they oil and gas companies? Are they truly international energy companies when over 80% of their capital goes into the legacy business? And so I think, how do we value these companies in this situation is really important.
We have a related question from the digital floor from Scott Thompson, who says, what are auditors doing and saying when valuing the reserves in listed fossil fuel company in light of these risks? I mean, it brings us back to the financial crisis of 2008 a little bit, doesn't it? What are the auditors and the asset company, these companies doing? Tiffany, any?
Well, I'm not an auditor, but the only thing I think I can add to that question particularly is the amount of concern we have from companies about being audited on this information, particularly in the US, where it's they're always worried about being sued. So they're worried about how much information they provide and how auditable that information is. So getting auditors up to speed with how to assess this information is obviously part of the knowledge transition that we're going through as well.
And ratings companies are doing a lot on this. I mean, barely a week passes when I don't get a press release from S&P or Moody's talking about their new ESG, better valuation, better understanding. I mean, there is more understanding than there was previously of the risk, it seems fair to say.
Sure, but then there's also making sure that we're opening a bit those black boxes of what these products that are termed ESG or sustainability or climate lined actually are. And I think there's been a lot in the press in that recently as well too, but making sure that we're from the regulatory perspective as well, ensuring that there's some accountability if we're going to label products and services as being aligned or pro-environmental, that they actually follow through with those promises.
Yeah, I think the ESG funds holding Exxon is a interesting phenomenon. Any other questions from the physical floor here? I have more virtual ones. Anyone want to pull rank for being here in person? Gentleman there.
Yeah, thanks very much, Al. Obviously, a lot of problems and issues with gas, whether it's enormous piles of cash. How would you deploy that if you were saying C-suite? In terms of like practical solutions, these companies who are obviously getting inbound from ESG investors, sure, 90% of the time.
What do you, Oscar? Do you want to go?
I was just going to say very briefly. Your point, I think, is fantastic. The oil and gas majors are making record profits. We're seeing this constantly, and with their huge balance sheets, surely are in a perfect position to fund the transition to net zero. I think you said BP and Shell are kind of leaders very much in this area, and I think we need to see that happen. I mean, how we actually do that, maybe others on the panel have a better idea than I do. You can't necessarily sort of mandate capital flows, but at least from my perspective, where we sit, UK sit with our members, investors, surely investors have a role to play to say, look, guys. When they're speaking to company management in their year-round engagement activity, look, guys, what are your capex plans? To what extent is your capital spending and expenditure looking to fund those activities, those climate solutions that will actually bring us towards a more sustainable future? So yeah, I think that's a really great question, and I think there's definitely a role for investors to play as part of that in this future engagement activity.
Mike, any tips?
Yeah, well, I think I would give a slightly different answer, and I would say. For the transition to happen and to reduce the climate impact of, let's take the listed oil and gas companies and talk about sort of their integrated companies. It doesn't matter so much what they do with the capital, other than it matters that they don't perpetuate the business as usual by continuing to invest in new fossil projects and develop new projects. What they go and do it is really dependent a bit on the company themselves. So they've got a load of strategic options. They could go and invest in wind, solar, other renewables themselves, or they could return the cash to investors, and the investors could go and seek returns elsewhere. And that could be in renewable energy companies, but it could be in a whole host of other companies, which we hope are themselves businesses that are sustainable in the long term. But it's so I would say it's to ensure investors their money isn't used to perpetuate the status quo, which damages the climate and of course risks investors eroding shareholder value. But again, I draw the parallel between the distinction between a listed an integrated company that has refining midstream activities and refining and marketing, potentially has a broader set of strategic options than if you're a small exploration production company whose business model is predicated on finding new oil and gas, potentially developing it or selling those discoveries to the larger companies. And of course, that business model is potentially more at risk, and they've got even further greater at risk and have fewer strategic options. But I'd potentially throw the question back slightly to investors of where do you think the best place for your capital, either to not do harm, i.e. from a sustainability perspective, or to have positive impact, or where you think the best risk-adjusted returns can be had, and the opportunities, the energy transition. Slightly long answer, but hopefully they've sort of touched on a few points.
I mean, one thing I would say, actually, the Committee on Climate Change has got its progress report out tomorrow, which apparently is very long, but it's certainly worth looking at the executive summary. But there is a remarkable consensus now on what needs to be done. It's like amongst policymakers, investors, technicians, it's fairly well established. We need an absolute shed load more renewables, primarily offshore wind in the UK, also onshore wind and solar. We need improvements in energy efficiency. We need an electrified fleet. We need a bit of hydrogen around, and maybe some carbon capture and storage around the edges to do industrial decarbonisation. And we'll have an argument about whether we need nuclear or not. And it's kind of like, I'm simplifying it massively, and regenerative agriculture, which is difficult, but simplifying it massively. But it's there's a big body of work that basically says these are the areas that need more capital. This is what we plan to do over the next 20, 30 years. These will be relatively low risk investments because the policy's there and the technologies are relatively mature. So huge number of options would be my, sorry, I'm chairing, I shouldn't be talking. Just put my 2 pennies worth in there.
It's about delivery now.
It is about delivery.
All the stuff you're saying, James, what has actually happened since all these ambitions that you outlined were highlighted in the net zero strategy at COP last year. We need to see delivery today.
Yeah, and I suppose the argument would be what has happened is we've built a world-leading offshore wind industry and not a huge amount else.
Yeah.
And we need a lot more. Tom, you want to come in? And then I've got a couple of questions from the digital floor, and then I believe we're closing with Nick.
Just because of your bafflement, really, especially coming after the why nobody can do what's obvious.
Yes.
And because it struck me, something that struck me as all through the conversation. Brilliant policy analysis doesn't always, or even very often, turn into good political outcomes. And we don't have a political analysis that matches the policy analysis. And without that kind of political analysis, we'll go on being baffled. And if we're baffled, we'll end up where you started, by feeling pretty gloomy about the prospects. And so I think there's a bit missing from the argument. And Mark quoted a figure right in his introduction, which is actually, for me, the scariest number. $100 trillion of avoided revenues is $100 billion, and somebody's going to figure out how much of that they ought to spend on making sure that the policy doesn't work. And that's part of the political analysis. It's not an uncontested area just because we all agree about this problem or the implications of the problem for the energy world. That doesn't mean it's uncontested, but it may not mean that a lot of the people who are going to contest it are going to engage in sessions like this.
So your question would be just we're not thinking enough about the political economy and how to make the politics work.
How would you do it too? I mean, how'd you go about being a systematic? Here's this very systematic policy analysis. Really hard to find anything to say against it, which you summarise very well. Where is the equivalent political analysis that tells us why all these reasonable people who want to live in a decent world aren't doing it?
It's a good challenge. Yeah, it's an incredibly good challenge to the panel. I mean, what's your response to that? How do we get the political economy to work to deliver these, as you say, these changes that we're all in ferocious agreement about? Tiffany, I'll come to you first. You get the
I think this
privilege.
is such a good point, because look, we're preaching to the choir here. You're all convinced. We're not here to convince anyone in this room. And unfortunately, the rest of the world isn't all on board. I spent COVID back home in Canada, Alberta, oil country. And I realized I think I live a different world than everybody there. It was such an eye-opening experience for me to realize that my family, my friends, everyone I went to school with is pro-oil. It's funded their entire lives. And the fact that I even work in climate change is offensive to them. I mean, how dare I? So we think that the world's moved on quite far, but the fact that our politicians are not being held accountable, the fact that our politicians actually are being asked to buy pipelines and to move oil forward means that we have a large portion of the population that we have not convinced yet. So I think that's a really important point to bring up.
And Oscar, then is the challenge then for these big companies that are part of your membership, hugely influential, powerful companies, to be much more vocal in saying, no, actually, we're serious. We do want this change. This is not greenwash. We're not posturing. Please, Mr. and Mrs. Politician, deliver this.
Yeah, absolutely. I think the gentleman's remarks, I couldn't agree with you more. We want to show that, investors are not simply choosing a deregulatory race to the bottom in the UK, which is, excludes in the name, what we focus on at UK SIF. We've got a Conservative government that seemingly thinks at the moment that, lowering and diluting standards is the way to go, and that's the way to alleviate the cost of living crisis facing, many of us in the country and facing business as well. But, we want to show that, that's not the right approach. Actually, investors want to see, if anything, more regulation, particularly for the real economy, because that's going to provide the policy certainty and create the kind of right conditions for which investments can flow towards climate solutions and green technologies. And there's a huge role that we need to play at UK SIF. As part of that, we talk to governments and the regulators, every week. As I said before at the start of my remarks, making sure that we're not reneging on some of the commitments we made at COP26 and actually building on what we achieved there. And we'd like investors to be really vocal in that conversation as well. And we are finding from conversations that we have with investors that they are now starting to think much more holistically about, the impact that policymaking engagement can have on their ability to decarbonize their clients' investment and lending portfolios. And that's a shift that we've seen among investors, realizing that actually, yes, you can do stewardship with investing companies. That's great. That's good. That's going to help to an extent, but actually, that kind of direct policymaker engagement, getting those kind of real economy policies in place, like a price on carbon, that's going to really help shift the dial.
Yeah, absolutely. We're just going to wrap up with one last question from the floor, which I think we can probably answer in one word. Mike, it's coming to you. It's from Anonymous. If per the report, 90% of known fossil fuel reserves must stay in the ground to meet 1.5C, what is the justification for searching for more?
I think that hits nail. That we can see there's absolutely none. No, you can't develop what we already have. We don't need to go and find any more. And it's very clear.
And it's a very simple message around which campaigners and investors can, there's no nuance to that part of the argument. It's just
very simple.
Just don't. Excellent. Huge thank you to the panel, to Mike, to Tiffany, to Oscar. Thanks for the questions. Before we wrap up, I'm going to do a bit of promo. Business Green's hosting the Net Zero Festival on the 28th and 29th of September. It is a festival. We're going to be celebrating this has been a bit gloomy, hasn't it, to be honest? But we're going to be celebrating the wonderful technologies that are going to destroy the demand, that are going to make these assets stranded, and leave the people who invested with them and governments with the problem of dealing with those stranded assets, because that will be a lot less messy than dealing with a 2, 3, 4 degree world. And those technologies and business models are truly inspiring and exciting. So, please come to the Net Zero Festival, all invited. I'm sure I can get VIP passes for a lot of you. So go online, Google it, you can register there. Please do come along. 2 days of discussion along, because we, as always happens in these panel debates, we barely scratch the surface of what is the most important topic there is in the world right now. And I think, sounds like hyperbole, but when you unpack it, that is entirely true. There is, in the long term, there's nothing more important than this work. So all power to you. I do recommend having a look at the report in full as well. It's absolutely fascinating. And huge thanks to Carbon Tracker for their continued work 10 years on, a decade of hard work that has delivered considerable progress despite my slightly downbeat introduction. Now, to wrap up this afternoon, we're delighted to have Nick Robbins, who is, many of you will know, Professor in Practice for Sustainable Finance at LSE, who has the floor for the next 10 minutes or so to close.
So thanks everyone, and thanks for inviting me. It was some of you, I was at the first launch of the Unburnable Carbon with Mark and maybe Tom. I think you were there 10 years ago, and I've been given the task of thinking, well, we've gone through what's happened in the last 10 years, and I think the results have been paradoxical. We've had huge amounts of increasing commitments and recognition of climate risks in the financial system, and yet the performance numbers are going in the wrong direction. 40% more embedded emissions. So I'm going to be giving, and I hope the Carbon Tracker team don't mind, a bit of a heads up about what's going to be in the 10 years on reports in 2032. These are still embargoed, so James, don't but this is I think we've heard a lot of the signs in this decade. This is probably going to be the biggest switch in capital in the energy system ever, in terms of away from fossil fuels and into clean, renewable, and efficient sources. We know that emissions need to go down by 40% to hit the 1.5 level. We know that emissions need to peak by 2025. Perhaps fossil fuel emissions have already peaked, and net zero investment needs to go up by at least 5 times in this country, and perhaps 8 times in developing countries in net zero investment. So there's a huge switch in investments. And I suppose the question is, for the embedded emissions we've been talking about here, the embedded emissions in reserves that are on the balance sheets of oil, gas, and coal companies, what direction would we see that happening? As we see emissions coming down by 40% by 2030, that's what needs to happen, and continue thereafter. What direction do we think that the embedded emissions will need to go? And I would suggest they need to go down quite substantially. I'll come down to the final number right at the end. But so with this big capital switch, the report, I think, is really timely, because it does the second point really is, it's talking about what does a net zero financial centre look like? And this is really important. 2 years ago, I was delighted to chair a working group for the Climate Change Committee of the UK, which produced a report called The Road to Net Zero Finance, and saying the UK has a net zero goal for the country. And to deliver that, we obviously need a net zero financial system. So we recommend the UK becomes the world's first net zero financial system. Much to my surprise, Treasury officials read the report, and last year, the Chancellor, Rishi Sunak, announced that the UK would be the world's net zero financial centre. So a little bit of a weakening there, not a financial system, but a financial centre. And clearly, as part of a net zero financial sector, there are huge amounts of things, upside opportunities in terms of green finance, social finance, social impact investing, sustainable investing, and so on. But one of the key issues is going to be actually, what are the rules of the game in terms of continuing to finance harmful activities like fossil fuels, deforestation, and so on. So at the moment, the consultation is just closed for the second green finance strategy. I'm sure Oscar's been very, very busy in that. But this is going to be an important year to actually, what are the definitions of the UK being the world's first net zero financial centre. So some of the things we're going to need to see is, clearly we're going to need to see some rules around this question. This is an important benchmark of no investments in new fossil fuel developments, no further reserves, and a managed phase down of existing reserves and assets. So we'd want the financial centre, obviously the stock exchange, the companies that are listed there, the banks that are making loans there and taking companies to market and so on. We'd want to have those rules baked in. And essentially what we'd be doing is trying to squeeze the last part of carbon out of the financial system, particularly in this decade. A key mechanism for doing that is transition plans, net zero transition plans. This is the year perhaps of the transition plan. We have, on the voluntary basis, we have the Glasgow Financial Alliance on net zero coming forward now last week with their first set of recommendations for financial sector transition plans. And in the UK, again, we have the Transition Plan Task Force, which will provide the guidance for how major investors plus companies in the UK will actually have to report on a mandatory basis their transition plans from next year. So the transition plans are coming both on a voluntary basis, but also on a mandatory basis. And again, these will be key instruments, both to look at the company alignment, which Mike was talking about, but also the alignment of all the institutions, the stock markets, the banks and others who make up a financial centre. The report very helpfully highlights the role of policymakers and regulators. And again, I think this is something to watch very carefully. The Financial Reporting Council will be crucial to ensure not only that these disclosures and these transition plans are true and fair and aren't greenwashing, but I think the Bank of England and the Prudential Regulatory Authority will be really important to ensure that actually these transition plans are going to lead us to our 1.5 degree goal. Particularly the European Central Bank has been very focused on looking at the risks of misalignment from that. So that's plans, so more focus, I think, as we go ahead in plans. And then a sort of final point before I do the great reveal on the number, is I think the report, it's very clearly, and actually is a big shift from the last version 10 years ago, is, of course, actually, we talked a lot about London here, but actually the problem's elsewhere. And it's really interesting where the problem is. Particularly, you've got two big coal financial capitals, China and India, Shanghai and Mumbai. You've got two big oil and gas, particularly Saudi and Russia, and then you've got the US as well. The US is an interesting outlier because obviously it's a major market economy in that mix. What characterizes those countries? All are probably using fossil fuel subsidies to one degree or another, all have very weak carbon pricing systems. And most, to some degree, have not been particularly strong on sustainable finance. China has done some, India's picking up, and we know in the US and so on. But I think we need to look at where the global issues. And one thing which was really interesting, Mike, from your figure about the alignment of CapEx in different financial centres, is the most aligned financial centres turn out to be Moscow and Riyadh. Yeah? So in terms of those which actually look most protected or most resilient in this transition are those two, one under severe sanctions at the moment. So I think we need to think more globally as we think about this, and that means thinking about a just energy transition. The UK and the London Financial Centre as a net zero financial centre, I think has real assets in actually thinking about both the net zero and the social justice aspects. There's been UK investors who've been engaging with companies to have just transition plans, such as Scottish and Southern, and the UK is heavily involved in the South Africa Just Transition Partnership, which came out of COP, perhaps one of the more substantive areas. So I think my thoughts would be, we need to think about this as the decade of the biggest capital switch. We need to think about financial centres, the rules of the game. We need to be much more focused on plans, and then the global dimension. And then 10 years' time, in 2032, I'm sure that the good folk at Carbon Tracker will be inviting us back, and Mike perhaps will be releasing another one of these. And I'm going to steal your thunder, but we're going to be celebrating a 50% reduction in embedded emissions as part of this big capital shift. And the real question is just where it's going to happen. Thank you.